Hello, everybody. Welcome in. Thank you for joining. This is going to be a fun one today. We're going to talk about inflation, Bitcoin, gold, Goldman Sachs, and a whole bunch of other things that we all need to know and how to structure our balance sheet for the future. So without further ado, let's jump in. And a big thank you to everybody as well. You know, this channel is about math, money, and freedom. And it's gone from 0 to 85,000 subscribers in 90 days. So big thank you to all the subscribers and all the support. And everybody is so cool out there online, so thank you. Now let's talk about Bitcoin action over the last 11 years. So a quick little summary shows the percentage gains over the last 11 years. 2011 was a bumper year with 1,400%, 2012, 186%, 2013, 5,500%, 2014, it's what they call a nuclear winter. Now after 5,500%, to lose half its value is not too bad, but people complain. Then 2015, 33%. Kind of a very sucky year for Bitcoin. 2016, 125%. 2017, 1,325%. 2018, negative 72%. Again, another nuclear winter. 2019, 88%. 2020, 302%. And so far this year, over 100%. But what I want to look at two outcomes that are based on history. So what I did was I calculated that factor between 2013 and 2017 of a reduction. So let's call it a 0.24 factor. And a 0.24 factor of 1,300% is 318%. That times the beginning of the year amount, cost of Bitcoin, 30,000, gives us a price for 2021 of about 95,400. So we'll call that $100,000. The second way to look at it is imagine the factor is the same as 2017. 1325% times 30K will take us to 397,500. Now the reason that number is uncanny is that is very close to my number yesterday in the video and also Mike McGlone's number. So it's like everywhere I go I see fours again, and 4 is a special number for me. But that 400,000, who knows, could be very real. And the reason I think it's plausible, it's not going to happen, it's not investment advice, but this year is very different to past years because of the institutional investments and the high net worth individuals and the Morgan Stanleys and now the Goldman Sachs. So just want to start that off with a little bit of numbers, but it's going to be a lot more. So Goldman Sachs, this was another funny one, and I don't mean to poke fun at Wall Street. So the takeaway here from Goldman Sachs was in May 2020, cryptocurrencies, including Bitcoin, are not even an asset class. And 1,400% later, all of a sudden, Bitcoin's at $59,000, and they say, oh, it's time to jump in. They're opening up shop for Bitcoin. So who do you trust? And the real important thing to take away from this is it is now possible with the democratization of information to front run Wall Street. And that's what's very exciting. Let's go a little bit further. There are still a lot of people out there who are not convinced in Bitcoin. We just saw Goldman Sachs fold over and become convinced, but it took them years and years. And they're supposed to be the smartest people on Wall Street. So I know that 95% of the people on the earth out there are still not convinced, including some big names, some big professors, some Nobel laureates, people like Peter Schiff, top economists, and you name it. They're still not convinced, but I'm going to make the case in the next 10 minutes to convince pretty much anybody that you show this video to as to why Bitcoin is worth it, even at these prices. So let's talk about inflation first of all. Why inflation is punitive. So inflation eats fiat, and it has done in the history of the world. And in order to swim faster and not be gobbled up by inflation, excuse my crude graphic, you need your assets to grow faster than the inflation rate to survive. Some people call it a hurdle rate. Many people like Michael Saylor believes the hurdle rate for a business, he used to talk about it being 15%. Now he's saying 25% as a hurdle rate, which is akin to the actual inflation rate. Now, the other way of looking at this is if you have a debt in fiat, it can be a good thing. And I'm going to talk more about that as well as we go through this little presentation. So let's talk first of all about the damage that inflation can actually do to countries. So we have Venezuela, ongoing catastrophe. Inflation there is about 6,500%. Zimbabwe, They had a couple of bouts of bad inflation between March 2007 and November 2008. And today, it's 622% a year. The Sudan, 141%. Lebanon, 85%. So you can see that a lot of these, three of those top five are African-based countries, so they're being completely ravaged. You got Argentina, 49%, but again, these are numbers from Argentina and numbers from Iran at 31%. Can you really trust those numbers? They could be contrived. Somebody could be cooking the books, as they say. So again, take everything with a pinch of salt. But inflation can destroy economies. It can destroy businesses. It's supposed to be the enemy of small and medium-sized enterprises that just ravages them completely. But I'm going to show you some proof points as well where I believe inflation can be a real problem. But before we do that, we have to do a little bit of a macro lesson. So I'm going to jump in and spell this out real quick because I had some questions from some people from some comments I made in a video on Sunday. And this will hopefully address all of those questions. So first of all, M is the money supply. As we know, it's grown by 40% in the US over the last 12 months. So take all the dollars, nearly 20 trillion, and add 40% to it. So it starts at, 13, 14 trillion, becomes 20 plus trillion in no time. And their plan is to print more. Then you have velocity, which is the number of transactions. The number of times a dollar bill turns over is equal to the prices, which basically means the cost of stuff, and times Y, which is the size of an economy. So think if you buy some bread for $1, that becomes part of the economy. So it's real simple, not hard to understand. Where it gets a little bit tricky to understand is the following. So if you go back and derive everything, turn it into derivatives, and as you guys know, I love derivatives, basically divide everything by V, which is the velocity of money, you basically get M equals P. You eliminate V on both sides. So in that case, when M equals P, and to recap, M is the money supply, P is the cost of stuff. As the money supply increases, so does the cost of stuff. It's a mathematical formula that cannot be denied no matter what people say. You know, the government says, oh, inflation will be 2% this year. No. But because so many people were arguing with me online, I decided to put in some proof points that you can all check for yourselves. So here we are. Simple example. Lumber inflation. So the cost of lumber, wood, flat wood paneling, plywood, you name it, has gone up by 294.76% in the last 12 months. Does anybody care about wood? Probably not. But it's just one of those key things that is an essential building block to things like housing in many countries, like especially in the United States. So that's just one factor. Now, the reason I'm using wood as an example is it is important. And I put together a very crude analogy that people are still struggling with understanding the impact of inflation. So I decided to make up a little story like I like to do. So you take lumber, inflation, and termites. So imagine you were a termite on fixed income. So that could be Social Security, 401k, a pension somewhere in the world, whatever the case may be. And all of a sudden, you depend on wood. You eat wood every single day. What happens if the cost of that wood triples? Your fixed income is not tripling. And this is the problem. So basically, your food ration based on your fixed income means you can now only eat a third of what you normally used to eat, which is a big problem, especially for those people who've got to pay medical expenses and pay for cars and housing and all that other stuff. That's a very simple thing that everybody should be able to get. And this is scary. But let's go a little bit deeper. Let's talk about the recent catastrophe. So I was in a furniture store a couple of weeks ago. I think I told you the story. And they told us that the cost of all furniture had gone up by 10 to 15% this year alone because of transportation costs, not even taking into account the cost of wood. And then we had, of course, the Evergreen debacle in the Suez Canal. That is delayed things like semiconductors being delivered to car companies like General Motors and maybe even Tesla and others, which could have an impact. So you can see the transportation costs have been impacted and they're going up. And that's going to bring about a lot of inflation too. It's also going to disrupt a lot of businesses. So again, another example. But if you're still not convinced, try this. I put together a quick list of inflation over the last 12 months for some items that you may all be familiar with. Steel up 145%, oil up 80%, soybeans 71%, corn 69%, copper 68%, cotton 35%, coffee 34%. Step out for a second. I love coffee, so watch out. Wheat. The food index, all food is up 25% across the board. Bitcoin over the last 12 months, 1,400%. That's a good thing. And it's important as well to remember why I inserted Bitcoin there as well. It's okay for certain things to go up when you own them. Then you increase the amount of equity you have, the amount of your net worth. So think about that. The biggest one on the list is Bitcoin. So that's something you want to owe or own. We'll come to that later as well. Home values up 12% this year so far, not even the last 12 months. And money supply up 40%. So again, it's a bit of a list, but the real kicker is this. Reported inflation rate is 1%. So what's going on? I just proved to you that inflation's a lot higher than 1% by looking at all those common elements. But the problem is a lot of these common elements aren't actually included in the inflation indices. Again, the books are being cooked. So bear that in mind. But as usual, let's go a little bit further. Some people were asking for more memes, more comedy, so I'm going to try. And this ties into some of the conversations I've had with you all around CBDCs and negative interest rates. So the banks are in a position now where they want to charge you for holding their money. This is called negative interest rates. And what is that going to do? So if you start charging people to hold money in a bank account, we're debasing the currency of where people that are used to kind of saving money and getting 5 or 6% per year. That's all going away. So what are people going to do with the money? They're going to spend it. And when you spend money, what will happen? Inflation will go up because the demand for goods goes up. So again, it's a self-fulfilling prophecy. It's going to become a spiral that's going to get worse and worse as time goes on. Now, the other thing as well, CBDCs. This is the funny meme. Let me get this straight. They want to ban paper money to prevent us from being able to withdraw our money so they can implement negative interest rates and many other things, control everything else. So who out there wants a CBDC? Hands up. And they're coming. They're coming to Europe probably in the next 2 years. China already in motion. US, probably 3 years from now, it'll be there. So I think my personal take is that type of control over money, and somebody looking at where you get your money, where you spend your money, and how you spend it, and the interest rate you get on it, that is scaring the heck out of people. So bear that in mind. So how do we get the perfect hedge? Okay, it's pretty clear right now we have a problem. There is an inflation problem. And what would the perfect hedge look like? And this is kind of like a visual pun because it's a bull and I can be bullish on occasion. So let's look at gold. Now we're going to have to go dig a little bit deeper into this one. And I apologize for these numbers because these numbers have also tripped some of you up and has caused some vigorous debates online. But here it is all spelt out. Now, assuming a very conservative 5% and 7% real inflation rate over the last decade, and I guarantee you it's 5%. You just add up the cost of housing, the cost of education, the cost of medical, the cost of insurance. It is way beyond the cost of food, the cost of blueberries, the cost of Big Macs. It's way beyond 5 to 7%. So are you all convinced? I think so. So I ran 2 very conservative scenarios because, as you all know, I like to sandbag things. So this gives you what's called real purchasing power has gone from 220, assuming a 5% inflation rate, to 341. So what that basically means, and make sure you guys all get this, if you had $220 10 years ago, you need $341 today to buy the same amount of goods that $220 would have bought 10 years ago. All right. Now, assuming a 7% inflation, which is kind of more reflective of the truth, you need about $404 to buy that $220. So let's look at gold prices and see how well gold has performed as a hedge. So the gold true adjusted value, which means I have taken the gold prices, the average closing price at the end of every year, the opening price at the beginning of every year, the year high, the year low, the year close, average, etc. And you can see the changes of gold price over the years. So basically, in the year 2012, gold has gone from approximately $1,645 to $1,710 today. But the real problem is, if you imagine an inflation rate of 5% over the last 10 years, you have lost 34% on your gold in terms of real purchasing power. Now, if you take your 7%, you've lost 44.27% of your purchasing power on your gold asset that you believe is a hedge, that you believe will grow and increase in value over time as what many people call the best store of value ever. And I hate to burst your bubble, it's not. The last 10 years have sucked. I hate to use that word, bad word, but it has not done well. And they are the numbers that prove it. So what else can we do? So what is the perfect hedge? I like to look at Bitcoin as being the perfect hedge. But it's not just a hedge against inflation. It's a hedge against a few other things as well that I'm going to touch on today. But first of all, why is it a perfect hedge? And the reason is because of its limited supply. And if you've seen any of my videos, you know that it is not 21 million coins. It's not 18.7 million coins. It is about 14 million coins because so many have been lost. And of that 14 million, only 3.5 million are in supply circulating. So it is the scarcest asset ever in the history of the world. And that's what makes it powerful. And that's what makes it a perfect hedge. In addition to this beautiful limited supply, it's also a perfect hedge against things like unstable governments, police states that may be corrupt and may want to confiscate your assets. It might be a better solution against broken payment rails for those of you who may have tried to transfer money from one account to another, say for example from a traditional bank that's holding your cash to a brokerage account that trades crypto. It can take 7 to 10 days. And that is a broken payment rail. Then there are cyber threats. Are your assets secure in one of these traditional facilities? And with all the scammers out there, just be careful, everybody, with any asset you have anywhere, so they're out to get you. And as I mentioned, me being a little bit paranoid about scammers, paranoid leaders as well. People that want to destroy Bitcoin because they don't have any. So beware of all that. So that is why I believe Bitcoin is the perfect hedge. Now let's talk a little bit about something I showcased before, the new balance sheet. Now, some people believe in the new balance sheet, you should keep your assets in assets that will grow faster than inflation. The dollar will not. The euro will not. So think about moving all of your assets to things that grow faster. For example, it could be Bitcoin. And then keep your liabilities in fiat because they will depreciate over time. And this is another question that I commonly got as well from a lot of people. They're saying, what do you mean keep your liabilities in fiat and how you'll end up paying back less? Well, this is another slide full of numbers that'll explain that to you. Again, going back to my examples, assuming 7% inflation over the next 10 years, which I guarantee you it's going to be a lot more than 7%. It's probably already 7% this year so far after 3 months. But just assuming that, imagine you borrow $1 million today. That $1 million is expressed in the amount of goods or services that your money can buy. Inflation decreases the purchasing power. Remember, inflation and purchasing power are pretty much the same thing, i.e. the number of goods or services you would be able to purchase 10 years from now. So again, imagine you can buy $1 million worth of blueberries today. How many blueberries will you be able to buy 10 years from now? The answer is about $520,411 worth at 7% inflation rate. It eats into your purchasing power. So if you borrow $1 million, and 10 years from now you got to pay it back, effectively you're only paying back $520,000. Although the real nominal amount of dollars will be $1 million, but the purchasing power of that will be a lot less. So I think that's where people get tripped up, and I hope that explains it. Now, as usual, all roads lead to Bitcoin. Yes. I know you guys are saying that out there because you've heard me say it a lot. So quick conclusion before we jump in. To finish, based on the numbers, 2021 is shaping up to be a great year. Goldman Sachs, their case today means we can all front run Wall Street. and that's a fun thing to do. And of course, if there's more money, there's more inflation. I proved that today with a very simple formula. Inflation is also punitive, and it's not widely understood. People assume, oh, it's been 3% my entire life, so it'll continue that way for the rest of my life. No, it hasn't, and no, it won't. 7% is my min for the next 10 years, 15% is possible. It could even go a lot higher if we do get into that hyperinflation mode. Gold as a hedge failed over the last 10 years. Sorry for all those gold bugs out there. Sorry to break it to you, but that's a fact based on numbers. And the world needs a new hedge, and the world needs a new balance sheet. And inflation can be a positive. For example, if you have a mortgage, you can benefit from holding your money today, investing it in a more powerful asset, and then paying it back later. You can sell your more powerful asset that'll grow faster, sell it 10 years from now for dollars, and then pay off your debt. That's the message. So I hope everything was clear today. Again, lots of numbers, lots of facts, a little bit of macroeconomics, etc. But again, if you like this, hit the like, subscribe. Thank you, everybody. Take care. Be safe.